if I remember.
Yeah.
Well, welcome everyone to the Sanchez Wealth Management 2024 Economic Recap. I'm John Sanchez, CEO of Sanchez Wealth Management, and that handsome young man over there is Jason Gaunt, COO of Sanchez Wealth Management. How are we doing, Jay? Long time no talk.
Yeah, it's been a while. Yeah, it has. Great to see you. You're looking good.
Exactly. Looking good. Well, we thank all of you for joining us this evening. We really do appreciate it. And first of all, Jason and I both want to wish all of you a very wonderful Christmas and holiday season. And most importantly, health and happiness and a prosperous 2025. And we hope to be a part of that for most of you. We really do. So this is our last webinar of 2024. We kind of started these, Jason, what was our first month? Maybe 3 or 4 months ago? Something like that?
It was kind of late summer when we kicked this off.
Yeah. And they've been met with tremendous success. And so we really appreciate everybody attending. And we're going to continue doing these each and every month for 2025, and maybe even sneak a few more in, depending upon how much activity is going on in the markets and the economy, because it's a great way for us to communicate to those of you that are not our clients, as well as those that are our clients. So again, we really appreciate it. We kind of have record attendance tonight, matter of fact. So again, we thank all of you for that. So here's what Jason and I kind of decided. Okay, we're going to go through, of course, our 2024 economic recap, kind of looking back of what has happened so far in 2024. We're going to look forward into 2025. But, when you get into these type of webinars where you're doing a lot of look back and talking numbers and GDP and inflationary data, et cetera, it can be really dry. Well, all of you know us from listening to us on the radio, or you know us as being our clients. That's not who we are. So we're going to put up a lot of data, but we're not going to sit here and bore you with, look at the GDP forecast, blah, blah, blah. Nah, that's not who we are. We're going to sit here and talk like two guys that love the markets, which we do, and really try to, bring it to a level that everyone can understand. Then when we're done, we should probably take 45, 50 minutes is usually what it takes. And then we'll open up the last few minutes to a Q&A session. But if we don't get to your question, or if you're a little camera or chat room shy to pose your question, and Jason will explain in a moment how to pose your question, by all means, just send us an email, John at SanchezWealthManagement.com or Jason at SanchezWealthManagement.com, and we'll answer your emails. You can send it to our office mailbox, office at SanchezWealthManagement.com, and we will respond. We'll pick up the phone, call you, or we'll respond to your email. So, we're always very attentive to whatever your questions are. So we'll do that. Jason, why don't you enlighten everybody on how they participate and ask their questions?
Yeah, so the chat function is enabled. You can send us chat messages. Just John and I see them, so they don't blast out to everyone. So feel free to drop any questions in at any point in there, and we'll get to them as soon as we can. And there's also a little handout there that you can choose for speak to come on as well. But the chat function is probably the best, just to lob anything at us, and we'll certainly get to them as best able. Or again, as John mentioned, you can send us an email and we can respond to you on the fly as well.
And we have our emails open in front of us too. So yeah, we can answer those emails now or later, or whatever you want to do. So with that said, I do want to give you guys a little bit of background for those that don't know us. Maybe a friend referred you over to the webinar. I founded the firm back in 1999. Jason has been with us for 5 years. As of a few months ago, he is now officially a partner of Sanchez Wealth Management. We are going to be doing some rebranding that we're very excited about in 2025. The name will actually be changing, and we're going to be bringing on a significant amount of new products and services and things that, again, we are very, very excited about. We manage just north of $320 million as of today. So we're not huge, but we're not small. We have the capabilities to compete with any of the major Wall Street firms that are there. We pride ourselves in knowing our clients. You're not just a number, you are our family. And that's how we really differentiate ourselves. Between Jason and I, we have north of 55 years of experience on Wall Street. His majority on the institutional side, mine solely on the retail side. So I think that's why we make a great partnership and bring our knowledge and skills and passion of the markets to you. We do a lot of institutional portfolio management. which again, we will talk about it at probably another webinar next year. But we have the capabilities, again, to do anything. We have portfolio lending, again, just about anything you can imagine, we have the capability of doing. And so we're very, very proud of that. We've had significant growth in our assets under management in 2024. And again, for those of you that are clients, we want to thank you for entrusting us. We take our responsibilities very, very seriously, even though it's been a incredible year. God willing, it continues to hold here for the next few weeks. But we are diligent. We work hard. We each put in about 14 hours a day, sometimes 7 days a week, taking care of our clients, continuing to monitor the markets, even when the markets are closed. Because as the old Wall Street saying says, money never sleeps. We want you as our clients to be able to go live your life, and we take care of all the behind the scenes stuff so that we can help you fulfill your retirement dreams. So that's who we are. And again, we'd be more than happy to share any more details. You can find more of our bios, etc., at the website. So with that said, let's go ahead and get this party started. So here's our table of contents we're going to be going through. We kind of did the intro, our team. We're going to give you an economic overview again of 2024, because as we always like to say, it's wonderful to learn from what's happened, right? Wall Street loves looking in the rearview mirror. Times are going to be completely different next year. It's going to be unprecedented in many fashions, but there's always something that we can learn, things that have gone right, things that have gone wrong in 2024. So we'll do a little recap there. We'll talk about the performance year to date of the stock market. We'll talk about portfolio impacts and some trends that were very prominent in the year of 2024. Some major challenges that investors faced. It wasn't all just roses. There were some challenges enlightened throughout the year, some opportunities. And then most importantly, what I'm really excited about is to talk about 2025. As you've heard Jason and I mention on the radio show, and don't forget, you can pick up our podcast anywhere if you missed any of the shows. We are so optimistic about 2025 that, in my 35 plus year career, I can't remember feeling so much optimism in the air, and we'll share with you why we feel that. And then, as we said, we'll conclude with our Q&A session. So let's get started and get down to some of the details. Jason, why don't you go ahead and take this first slide, and let's talk about some global GDP growth, et cetera, without putting our wonderful audience to sleep.
I will do my very best. Remember, the U.S. is a consumption-led economy, right? 70+% of our GDP is consumption. Unfortunately, as it is now, that's what we're good at. Hopefully, over the next couple years and decade, we start to see some of that production come back to the States. We export a ton of ideas, technology, AI, which we'll hear an abundance of tonight and clearly over the next several years. But GDP at this point really rebounded off of what were depressed levels given COVID, et cetera. And we got to a point where things were too strong, right? We had inflation. That's obviously been a clear issue for consumers and voters. And that is a reason why we saw a big, I'd say, tidal wave of red come the election. And inflation was a very, very large deal. We've seen inflation come down, and we always pound on the fact that, remember, inflation coming down doesn't mean that prices are going lower. They're just going up less. Deflation or true disinflation is what causes prices to physically go lower. And we have seen some areas that were causing problems see lower prices. Used cars, just today in the CPI data, we're starting to see even owner's equivalent rent come down, which has been a big issue as far as these elevated costs for consumers and, as I mentioned, voters alike. So our expectation is that inflation continues to moderate. There are areas of the economy, grocery, et cetera, that probably won't see prices come down a whole heck of a lot. But again, that stagnating, the spiral higher that we saw over the last couple of years because of COVID and global demand, mind you, I think will start to moderate a bit. And that's a reason why the Fed will most likely continue to lower rates. We expect to see 25 basis points of rate cuts later this month. I think it's the 18th, right, John?
Yes, that's right.
And then, probably a little bit of a pause for a month or two as to see, has CPI moderated, has PCE moderated, but still expectations of the Fed lowering another 75 basis points to 1% in 2025. People ask why. Why is the Fed going to lower rates? It seems like inflation is, at a tough spot and potentially could tick up. It's because they're still at 4.75, and CPI is right around 3, right? They are still very, very aggressive in terms of their inflation fight. And given the lagging effect of interest rates and the Fed, they need to make sure that they aren't behind the curve if things start to slow down, both on the growth side, but also just in terms of the economy in general. Labor market, the last part on the slide that we'll touch on, it's been very, very strong. We've had low 4% unemployment. Some will roll their eyes and talk about how things are counted, but truly, classically, the economy is still on solid footing. And we have started to see wage pressure wane as well, where back in 2022, even early 23, it cost a lot to hire that incremental worker to get them off the sidelines because the government was your competition in terms of their paychecks. That's changed. And I think that labor costs will continue to come down over the next couple years, certainly with this administration. And globally, you're going to start to see that deceleration of employment costs, both domestically as well as internationally. So I think it forms a fairly positive backdrop into next year. Lower rates, hopefully inflation continuing to moderate, and central banks that are all globally aligned in most cases to keep the economies of all of their countries humming along.
Well, I think the central bank policy is probably one of the most important things, Jason. Again, we do have unemployment now down to 4.2% as of November. It's been hovering, right around, like you said, the low 4% mark side of things. But I think most importantly, I think it's important for everyone to understand, folks, there's really two things that drive the stock market performance, whether we're talking an up market or a down market. Number one, it's corporate earnings. It always has been. It always will be. And number two is central bank policies. What is the Fed saying? What are we anticipating they're going to do? And there's a lot of discussion right now whether the Fed should even give us this 0.25% cut come the December 18th meeting. They're going to do it. This has been a hotly debated topic we've had with our clients. They're going to do it. They have to do it. They've said they're going to do it. And the street would be very, very disappointed if they didn't. Does a 0.25% mean anything? No. It's like spitting into the wind. It's the bond market is the ones that really set the rates. But it sounds good. The Fed's, accommodative, the term that you hear a lot. So don't get all excited because we're going to get a 0.25% cut. Most importantly, what's the perception going forward into 2025? It's all over the place. I don't even want to venture a guess or tell you what we think is going to happen because the Fed doesn't even know what they're going to do. I think it would not be surprising. I think you would agree, Jason, that come January, they kind of sit back and maybe give us a pause, right? And they want to kind of see how the year starts, and obviously a new administration towards the end of January coming in, and maybe, like I said, a January pause. Does the street really care? Not really, because what we're looking at is what is the trajectory? Is it a trajectory of rates coming down or is it going up? Obviously, it's coming down, which again is always very, very positive for the equity markets.
Just real quick, John, in the chat, yes, we will share this deck with you folks after the presentation if you ask for it. Just email us, office@sanchezwealthmanagement.com, and I'll make sure to get it over. Thanks, Joel.
Absolutely. Great point. All right, so let's talk about how this market has done, how your portfolios have done, so on and so forth, because it has been an incredible year. I think this year was very much of a surprise to everybody. Jason and I, at the beginning of this year, we told our clients and we said it to our radio audience, we anticipate a lot of volatility in 2024, and indeed we have got that. But luckily, the volatility, the trend again has been up, not down. So as of yesterday, of course, well, matter of fact, I'm going to just jump, Jason. I got the numbers through the close of today because I wanted to mention today with it being a record-setting day on the NASDAQ. So year to date, the NASDAQ's up 33.5%, S&P's up 27.6%, the Russell 2000 18.1%, and the Dow Jones Industrial Average 17.1%. So, in Jason's old days as a hedge fund manager, Jason, you would love to have just closed the books right now, right? just book those gains. We can't do that, but it has been a heck of a year, and it's been a year that, we've had our periods of volatility, as we'll talk about some geopolitical tensions, kind of sparked some concerns throughout the year. But overall, again, as we'll talk, AI has been a driving force. The NVIDIAs and Microsofts and Teslas and so on and so forth of the world. The market can't get enough of these companies. And again, it's almost like going back to the 99, 2000 era when this great thing called the internet came about. People just had so much excitement about it. that they want to get involved. They kind of buy anything that's related to it. The volatility trends, again, periods of heightened volatility were observed, especially around major policy announcements. Boy, did we see that. Again, today we closed at a record on the NASDAQ Composite. And it was an amazing close. You've got the markets, as of a week or so ago, all three were, meaning the Dow, the NASDAQ, and the S&P, were all in record territory. And you just don't see that a lot. And the great thing is statistics show that going forward into the next year, at least, the markets tend to do pretty well. Probably not to the extent they're doing now, but they still continue that momentum going into the new year. Sector performance-wise, leading sectors, kind of surprising, utilities, technology, no surprise there. The financials, because again, those are interest rate sensitive. The lagging sectors, the healthcare, the materials, the real estate, those are very interest rate sensitive. They have been improving, like the real estate has been improving as rates come down. Healthcare is just a disaster with the tragic shooting of the United Health Group CEO the other day. All of a sudden, everyone's talking about how much they hate CEOs around the country, but the healthcare sector, there's some talks that's going through Congress at this point that we'll watch very closely next year, indicating Congress may be pushing for a breakup of some of the benefit managers and some of the major health insurance companies, etc. We will see, but that sector has been a tough one so far this year. The drivers, the earnings, my goodness, Wall Street has corporate America has surprised Wall Street time and time again. Wall Street's been very forgiving in most cases for companies that maybe have guided a little bit lower, and then they come back. But overall, they're forgiving from the standpoint. Okay, I'll give you an example, like Oracle. The company missed their earnings numbers yesterday, but the stock is starting to stabilize already. We've seen that over and over again this year. That's a sign of a very bullish market when the street goes, okay, yeah, we're going to punish you now for what you did in the previous quarter, but we're optimistic about your guidance going forward. So again, that's another telltale sign of a bull market. And then geopolitical events, my goodness, we don't want to have to relive Israel and Hamas and all of that situation. Luckily, things have somewhat quieted down there. We'll, of course, continue to watch the geopolitical side of things going forward. But this market, don't you agree, Jason, was very resilient in some of the situations, such as some of the various missile attacks, where I was more nervous about it than you were, thank goodness. And the market really was a resilient factor. It kind of brushed it off in many cases. Yeah,
and again, it seems, to your point, at some point it matters, right? And lack another thing to focus on, it probably really would have. But there's so many trends going on right now. Again, the artificial intelligence, machine learning, obviously data center build-outs, utilities being such a strong sector this year, the use cases for this ingestion of data are astronomical, right? And does it set ourselves up for disappointment in the future? Quite possibly, right? That oftentimes the reality tends to come back to bite you. But there are a lot of things to be excited about in the market and also the economy. And we talked to, I probably said till I'm blue in the face, that the demographics are playing a massive role. John, we had a great show pretty recently just about investors and how the younger investors have started to dominate the market as well, because the average age in the US being in their mid to late 30s. The millennials are gigantic, and they are very active in the stock market. They're active in crypto trading. They're active in lots of different investment lines right now. And that's creating a very favorable trading environment. And finally, there haven't been a lot of new issuances. There's not been a lot of IPOs. There aren't a lot of other companies for people to invest in. Therefore, this suite of choices is really your suite to be allocating to. And a lot of money has been moving into this market, either off of the sidelines from high interest rated short-term treasuries, but more so just the age of folks being able to invest and moving into their prime earnings year. So there's a lot of positive for sure last year and then leading into the next.
I made a comment yesterday on the show for those of you that may have missed it, and I think it's very important to Jason's point. When I was a brand new broker at Shearson Lehman Brothers, we had this Harvard economist by the name of Harry Dent, and he's still around. And he came into our office, and he was, a young guy himself. And he sat us, there's about 35 of us brokers, and we're sitting around this big conference room table. We didn't know who this guy was, and he came in and he had this philosophy called the baby boomers, right? No one had ever heard of this. This again was in the early 90s. And the analogy that he gave was, he said, watch and see the demographics, how they change and how favorable they will be to the stock market in the next few years because of this demographic called the baby boomers. And he said, the best analogy I can give you is, a big python snake just ate a big rat and it's working its way through the python, in the digestive system, not to sound real gross here. But he said, that's what's going to happen to the baby boomers. They're going to move through the economy. They're going to be one of the largest driving economic forces since World War II. And lo and behold, was he right? Right? I mean, man, was he right? And to Jason's point, this is what we're seeing with the millennials. That's why we've been doing quite a few shows about the millennials. This group, this demographic is actually larger than us baby boomers. And so they are really a group. They're quasi interested in the stock market and, like Jason said, into crypto and a few other things. They also are interested in real estate, and they really haven't had a chance. This is why we're bullish on real estate. They haven't really had a chance to get out there and buy that first home because interest rates have been higher. So we think if rates continue to come down on the 30-year mortgage, you'll see this group that many are still living at home actually break out. And hopefully the Trump administration will come up with some creative new financing, first-time buyer programs, et cetera, and get these builders building more homes and get these millennials buying some homes. And that should really propel the equity that all of you have in your homes currently. So they're a viable force. There's all kinds of great information on the internet about it, but they're a force to be reckoned with. And again, they're just coming of age right now. So they're going to continue to push this stock market in years to come. Portfolio impacts, inflation and interest rates. Boy, do those ever impact it, right? We started this year worried about inflation. And Jason, luckily, we're trending down. As you indicated, we had the CPI numbers today, up 0.2%, just a smidgen below 3% on headline numbers, a little over 3% on core. The Fed got its way. How'd they do that?
They got their way in that they were, fairly aggressive, and then now they get to jawbone as much as they possibly can. They use data. They clearly were of the assumption that this market and the shocks were to some extent transitory, not clearly, as we all know, they all weren't. But there are parts that were very much a function of supply chain. And so now, as interest rates have risen, the Fed has slowed inflation. They're flipping back that other direction to become more accommodative as far as their policy is concerned. And the expectation is they continue to do so into next year. The current, the new administration is talked about also wanting low interest rates as well. So Powell's got another year and change as far as his tenure is concerned, but
his job is safe.
Yeah, exactly. But the jawboning, I think, from Treasury with Bessent as well as Powell will continue to at least be a tailwind. And I'm very positive on Bessent as far as a choice. He's got a tremendous pedigree as far as hedge fund management and complex derivative knowledge.
Explain who he is for those not familiar.
So Scott Bessent is going to be the new Treasury Secretary with Trump's administration, and he has again, you can go look on the Google machine, but a pretty extensive background of complex strategies, derivatives. That's the kind of person that I want in the seat if things start to go a little bit haywire, someone who's a true practitioner versus more of a scholar, for lack of a better term, like a Janet Yellen would be, just to give you a sense. So I think, inflation is going to be key. Alternatives, right? They dominated the landscape this year. Private credit, private equity, some of those less liquid strategies. Again, John and I are slightly concerned about them. Just if things do at some point slow, I think private credit could be an area of the market that may have some Pandora's box to it, where lots of folks start to chase after yield, chase after investment allocations that may prove daunting. So that's one that I would throw out there with an asterisk and have you be a skeptic, at least if you're looking to allocate towards something like that. But it's been a a very good year if you were very tightly allocated with the best game in town of the S&P 500. And we've talked about emerging markets up, anywhere from 0 to 15% this year. India dominated the landscape as far as even helping emerging markets. China way underperformed. You've got developed Europe has had a tough time getting out of its own way. It doesn't have as heavy of an AI tech exposure in their markets, and those have been some of the biggest leaders this year. That's why those areas have underperformed. Again, we'll touch on it a little bit later in the presentation as to potentially some opportunities there. But we'll always preach diversification. You don't want to be all on one side of the boat, even though this year it was certainly fruitful to be sitting on one side of the boat. But it does tip over at some point. I would just tell folks to make sure you're not too skewed heavily to large cap growth, because it's truly trading at top decile versus itself over history. So it doesn't tend to prove the most fruitful of an allocation over 3 and 5 years after the fact. So there's still opportunities, but 2024 was very much a large cap growth favored environment.
Absolutely. What were some of the major challenges that we as investors faced in 2024? Well, number one, as we said, inflationary pressures. By far, as portfolio managers, this is one thing that we battled along with all of you, right? Persistent inflation, that affects, of course, the purchasing power, it affects investment returns, et cetera. And of course, that was, one of the reasons, in our opinion, that Trump won, because frankly, all of you were very, very upset that it was costing you a heck of a lot more to go to the grocery store, to the gas pump, to do any, buying whatsoever in your personal life. You were very frustrated with it. And I think everything, spoke to that when it came to the election. So once again, this is why it's so very important that inflation remains in check and continues to slightly decrease. We don't have a long ways to go. Remember, again, we only have, give or take 1% to what we call the Fed mandate of 2%. We're slightly, high twos, low threes, depending upon which metric you look at. So not a long ways to go, but this last mile will be very difficult to achieve. It's probably going to take, as the Fed has said, a couple of years to get down to that 2% mandate. And I mean, the Fed can't predict what's going to happen next week in the economy, much less that it's going to take 2 years. So it's anybody's guess, but all the street looks at is, where's the trend again? Is it up or is it down? And the trend is this, right now it's kind of holding flat. But I think overall we're going to see it begin to nudge down. As we mentioned, the interest rate volatility, this was a major challenge that we all faced. It felt great to park our money into, CDs and money market accounts at 5.5%. But those that party's over. That train has left the station. And many of you now are contacting us and saying, what are my alternatives? What can I be doing? Because my renewal rate now is 3 or 4% on my CD. And we do have all kinds of alternatives for you, for that, what we call that safe money side of things. So it can definitely happen. But yeah, boy, this market would move in massive swings, of course, whenever we saw an economic report or something happen to make those rates fluctuate either up or down. And like I said, luckily, as we come into the end of the year, that trend is starting to come down. We touched on the geopolitical uncertainties. Those are always going to remain. Those are what we call an outlier, right? We know they're out there. They can be what we call also a black swan event, something like, the drastic, unfortunate attack back, over a year ago on October the 7th in Israel. That just came out of the blue per se. And so, those things tend to happen on a weekend. And then, Jason and I are alerted that things are going on, and then our stomachs drop because the futures start trading at about 3 o'clock on Sunday afternoons. And we get to sit there and not spend time with our family, but worry about what Monday morning is going to look like. So those are always going to be there. As we'll share in our 2025 outlook, we do have some concerns on the geopolitical outlook going forward, especially on the tariff side. So I'll just leave it at that. We touched on the diversification challenge. Don't feel bad if you underperform the S&P 500 if you have a diversified portfolio. That is the best way to go. Don't chase this market. And lastly, the shifting consumer trends. Well, we saw a lot of changes going on with the consumer. The consumer is still extremely strong. They're still out there spending money because you have a job. But, one thing that Wall Street watches very closely are retail sales. I mean, we just wrapped up or getting close to wrap up third quarter earnings season. And it was amazing, right, Jason, that we saw some retailers just do phenomenal and others just completely strike out. So once again, it's about demographic trends and where money is being spent and so on and so forth. So the consumer is definitely shifting. but the most important thing that we look at is, do they have a job? Yes. Are they out there spending money? Yes. We know that by personal income and personal spending data. So overall, consumer, high five to you. You're doing very well. Keep spending. All right. Opportunities unearthed in 2024. Take it away.
Yeah, I mean, again, there's just a couple high points here. I think view this slide probably as things that have been going on throughout 2024, but also opportunities into 2025. ESG, environmental social governance focus, right? I mentioned the millennials. It became very much a political lightning rod as far as environmental focused investing, left, right, center. Clearly, it is more of a left focus, and people reacted to it. But I believe there will be opportunities in that space. I always like to say that the stock market's the only store in the world that when everything goes on sale, everyone runs out of it, right? So, opportunities that may present themselves in longer term strategies like solar, battery technology, nuclear. We're seeing, these sort of small modular reactor type stories that folks are very much keeping an eye on, given all of the needs for energy, right? Various energy sources, despite one being viewed as a political minefield, for lack of a better term. I think you're going to really be able to pick away in the ESG space because of a lot of these names having been crushed over the last year and left for dead, that may present themselves pretty good opportunities in some of those sectors that I talked about specifically.
Yeah, that theme that you mentioned is so exciting about the power plant situation. And just real quickly to go into a little bit more depth, what Jason's referring to, we all know that AI and crypto and all these things, they take a lot of power for these servers, et cetera, these massive chips that are, well, I shouldn't say massive, but high-powered chips that are running the world now. And so you hear the term server farms, right? These big, massive server farms. We have a lot of them, here in Reno, right around different areas. They're all over the country. But what we're starting to see now is, the typical utility company of the world, they can't supply enough energy for these server farms that are popping up everywhere. And so therefore they're like, what do we, these companies are like, well, what do we do? Our local utility can't provide to us. And so this new technology of nuclear power, for many of you that are aware, they're refiring up a portion of 3 Mile Island, which I never thought in my lifetime I'd see that after the disaster that happened before. But technology has changed. They're creating nuclear plants that are smaller, more efficient, that they can build in a fraction of the time of the old traditional nuclear plants. So again, that's just some of the great things going forward. So I just wanted to go into a little more detail because it's a fascinating strategy.
And very much not uncommon as far as technology is concerned. We tend to put the cart before the horse, right? We talk about electric vehicles, yet we don't update the grid sufficiently. We don't update storage sufficiently, right? The way that I always like to try to think of these ideas is just because the time is not now doesn't mean that it inevitably isn't going to happen, right? So trying to keep some of these items that are the hottest thing now that then are left for dead. I like to say always, I always feel like they come back again in sort of a new way. So be it, like I mentioned, a solar or something along those lines. AI is going to open the door to everything. And again, I think it's the most overused acronym in the whole wide world, but the ability to digest big data is going to massively change everything we do. I can't even comprehend.
See how excited he gets? He's speechless.
I mean, again, I keep talking about drug discovery. I think that biotech, CRISPR, gene editing, AI usage as far as diagnostics, personalized medicines, these are all things that we're going to hear more and more and more about over the next few years, not decades. Clearly, decades we're going to see advancements, but I would expect if you're doing research on areas like some of those that I mentioned, you're going to find a lot of gems in there, even if it's allocating to a broad-based index of some kind that owns biotech or those types of strategies. Now we're looking for bank shots on AI, not who makes the chips. It's more of who's going to benefit from this technology. the cat tractors is, as John would know, or the deer, where you sit there and put your cup of coffee down. Thanks, Jack. It's Tuesday. You put your cup of coffee down and it's basically going to plow the entire field for you, right? Merely because of GPS and data. And, systems will just continue to get smarter and smarter. So it's very exciting, but there will be potholes in the story, just like everything. But autonomous vehicles, you name it, it's going to be an exciting decade for sure. But even the next couple of years, there's going to be a lot of important announcements.
Absolutely. And again, one of the reasons we're so bullish on this market going forward. All right, so that's 2024. What more do you say when you, again, talk about indices that have, traded as high as they have this year? Like I said, keep our fingers crossed. Jason and I lived through 2018, and things were great up until the last week or so, and then a couple things happened in the market. We sold off about 5-8%, somewhere around there, just a few days before the market or before the year ended, and luckily we rebounded. So you never can say never when it comes to the market, but so far, like I said, I wish we could close the books right now and go down in our books is a phenomenal year, but we will see. We think the momentum will continue. That's 2024. Now let's get real excited and talk about what does 2025 have in store for us. Well, global GDP growth, again, looking to be fairly steady, about 3.2%. Inflation expected to decline to about 4.4% globally. Again, that's on a global basis. Here in the U.S., we're already well below that. The central bank policy, again, as I joked and interrupted Jason, Powell's job is safe. That was something the street was very concerned about with Trump, that he was going to fire Powell like he wanted to do in his previous term. He's just a few days ago made it very clear that he wants Powell to finish out the rest of his term, which the street loves. The street does love Powell, and I do too. And I think that was a great move on Trump's part. But, potential for gradual interest rate reductions, as we talked about, that's going to continue. Like I said, I think the bulk of the decreases in interest rates have been done in 2024, even though, we haven't had a lot, but I think we're not going to see a significant amount, because remember, folks, starting in January of 2024, the street was looking for, what was it, Jason, 1.25%, 1.5% worth of interest rate cuts in 2024. And
1.5% was the expectation.
Yeah,
it will be 1%.
Yeah, exactly. Yep. And so, but we managed to survive. Isn't that amazing how that happens? But as long as we know that the central bank is on our side, that's all the street cares about. Whether we get 0.25%, like I said, in January or not, doesn't really matter. It's just, what's that trajectory going to be in the long term? The geopolitical influences, the ongoing trade negotiations, and international relations may impact the market. This is probably one of our biggest concerns of 2025. And what we mean here, we really couldn't come out and say this, but we'll say it right now. This is the tariff situation. Now, those of us that voted for Trump, we knew going into his term that he is very pro tariffs. Now, we still have a lot of tariffs that were left over from him, and even the Biden administration has increased, such as ones to China. But our biggest concern that we have to watch is, and it just happened a couple of weeks ago, where he came out of the blue and said, look, we're going to impose a 10% tariff on Mexico and in Canada. Right? That was out of the left field. He's not even in office yet. Continue, 25% or so with China. We don't want to see that tariff tit-tat war going on, because immediately, Mexico came back and said, all right, you're going to slap a 10% tariff on us. We're going to do the same thing to you. And that's what we mean by tit-tat, tit-for-tat type of scenario. We slap a tariff on a country, they slap a tariff on us, and now it turns into a major, major economic disaster. Again, we could do an entire webinar on whether tariffs are good or bad. We all have our opinion on there. All we care about is what is going to be the market reaction. We're concerned about it if they, again, go after the tariffs in a very aggressive fashion and really, excuse my language, but really piss off our allies. That could create problems. That could starve economic trade and trade imbalances and GDP growth on the global basis, so on and so forth. So that's probably one of my biggest concerns. You agree with me, Jason? Is that one of your top?
Geopolitical has been, ironically, probably the concern for me. That the domestic economy I'm comfortable with.
Yes.
But I sort of simplistically say that if China lobs a grenade at Taiwan, that we're going to wake up the next morning, the market's going to be down 10%. Doesn't mean it's going to be up, not going to be up 5% the next day, but markets are going to be very reactionary to all of this at some point, right? They've been muted, but love him or hate him, Trump has had a fairly incendiary relationship globally, right? He, and given Israel, Hamas, and U.S.-Mexico issues, China, Taiwan, South Korea, North Korea, there's a lot of, I would say, angst globally right now that those types of things could certainly derail our economy, regardless of how well things are humming along here. If the war word starts being talked about more, I would say emboldened. Not to say it's going to happen, but that would be a fear. That would be something that would, to some extent, reset our expectations to something probably a little less excited or fruitful than what we'd expect.
And I know it's going to upset some of you, but we have to tell you the way we're feeling and what we're looking at. Also, as we mentioned on the radio show, the deportation, right? If millions and millions of Mexicans get deported, we could see a significant impact on the likes, as Jason was mentioning, of agriculture, of construction, of hotel trade, so on and so forth. If the millions and millions get deported, as he has claimed that he's going to do, that could have an impact. You could start seeing corporate America here in the U.S. coming out and saying, we're lowering our earnings numbers because we don't have anybody to work. We can't service the public. We don't have enough people, in the seats to do the jobs. So we will see, of course, on that one. And again, it's just something that we have to kind of keep in our back pocket as far as a potential concern. The industry growth, we don't need to go over this again, sectors like technology, healthcare, renewables, absolutely poised for massive expansion in 2025. Wrap us up on the key takeaways, Jason.
Yeah, I mean, again, fairly clearly, there's a strong market this year, the inflation coming down, all the benefits continuing of AI and the excitement around technology boom there. We talked about demographics, the fact that you probably, if you made me pick a lateral to history, folks have heard me say, I think we're in the mid-90s, right? You take the boomers, back them up 30 years, you had the internet, you had explosive growth of retirement plans, and really the technology that was evolving inside of the stock market in general. And am I foreshadowing 2000? Hopefully not. But I think that we've got a lot of exciting things. And the market really responded. Even though valuation is on the upper end of what we would like to see, I still think that if earnings can continue to grow, which some are implying 14 to 16% growth even next year, then some of these companies are still not incredibly expensive. There's some areas that we'll be able to look at, trying to think of now not the chipset per se, but more of what can be benefited from big data efficiencies. People-wise, I don't think it's going to make everyone's job go away, but it'll make you better at your job or more efficient at your job. What companies can be benefited from things like that? So there's a lot of exciting things on the horizon that we'll certainly be picking away at on this side, and I'm fired up to turn the calendar for sure.
Absolutely. What we don't have a slide on this, but I'll just kind of take you, off record with some of the conversations Jason and I have as we strategize about our clients' portfolios and how we're managing them and going to manage them in 2025. And a lot of our clients are retirees; they're either in or very near retirement. And we did a show, and again, you can find our podcast a month or so ago about some of the challenges that the retiree faces that is quite different from those of you that are still working. Tonight on the show, as you all know, we covered a lot about some significant increases in IRA contributions and 401k, 403b, et cetera. So those of you that are still working, I think you're going to have an incredible opportunity to put away as much money as possible. But yet the retiree is looking at things a little bit differently, right? We hear this from our clients, and I'll give you a prime example. Imagine if you were a retiree, so you're on a fixed income. And let's say, 10%, about normal, 10% of your investable dollars. So let's just make it really simple. You got $100 to invest, 10% or $10 you've had tucked away as your safe money, your rainy day money, your emergency fund, whatever you want to call it. Well, you've taken that 10% or that $10 in this example, and you've tucked it into, as we said earlier, some CDs, a money market, those type of instruments that are very safe. Your money's not at risk. And for the first time in years, you're receiving an incredible yield, right? 4, 5, 5.5% if you really got it at the top. And so what many of you are contacting us about is, Where's my alternative? Because my banker just called me and said, hey, that 5.5% CD is not, it's not going to renew at that. It's renewing at 4.5 or 4.75. And as you know, again, we emphasized it to our clients, and absolutely emphasized on the radio. If you knew that you had a CD coming due when rates were still up, we told you, get out there, even if you have to take a little early withdrawal penalty, and renew it for another year, 2 years, whatever the case may be, because that is one of the big situations with a retiree. They like to have, and they should have, some emergency money. So Jason, take this opportunity and talk about what a short-term treasury portfolio, how that can be used as an alternative if you find yourself in a situation where that CD or that money market is not yielding what you want.
Yeah, short-term treasuries, a stock bond portfolio is 60-40 allocation of stocks, dividend equities, and corporate bonds, right? Those are things that are all yielding quite well right now with very low volatility, and are fairly cheap, right? A lot of the dividend equities that are out there, value, for example, large cap value is trading at bottom decile, as in bottom 10%, versus large cap growth in the S&P 500 since 1990. It's saying that dividend stocks, which typically tend to be more value oriented, valuation wise, are quite cheap. So those are areas where you can look to deploy. Yes, you are taking more market risk, but corporate bonds, and it doesn't have to be high risk stuff. It's Procter and Gamble and Target and quality companies that have, Walmart, that have paid a strong dividends from bonds for a long time. So that's a good way to be moving out of what is more glorified savings accounts. You mentioned short-term treasuries. That's still the short end of the curve. Those rates have also started to come down as well, but you're just laddering either short-term treasuries or corporate bonds, trying to spread your duration a bit, so you're not just subject to near-term rate volatility. You're just buying something with the best yield you can get for the lowest amount of risk. And corporate bonds might be a good place to be looking at again into the next couple of years. I'm not talking out 20, 30-year stuff, but 5 to 10-year corporate bonds, I think, are going to set up very well, despite what the economy does, for some time, at probably a 5 to 7% yield, that versus what was a very nice, sweet, safe deal, but those go away. And so that's, these are the times you want to be looking at that versus when rates are at 3 and they're slim pickings.
Right, exactly. Another thing that we're very optimistic about in 2025 in regards to the Trump administration is the tax perspective. I can't tell you how many phone calls Jason and I, or emails, or we mentioned in meetings with our clients, people were concerned about taxes, right? And I actually just had a client the other day. We were doing an account review, and he stated, look, I've read on the internet, which always scares me, that taxes are going through the roof. Should I convert my traditional IRA to a Roth IRA while taxes are lower? And I said, hold on, time out a little bit. That was what the concern was if Trump didn't get in. There is no economist out there, no market strategist out there that is saying taxes are going to go up under the Trump administration. This, again, is one of the reasons Wall Street got very excited. And we had that, 1,500 plus point rally the day after the election. We do have, of course, the sunset provision that everyone was very concerned about, which was the tax policies and strategies, et cetera, that Trump put into place when he was in office in the first time. Those were set to, quote, sunset at the end of 2025. We don't know what's going to happen, but I bet my bottom dollar they are not going to sunset. They're only going to improve. So we don't think taxes are going to be a major situation. Again, all these questions that we've been receiving in regards to converting my traditional to a Roth, because I think taxes are going to go up. As I told our client, I think that's unfounded. And as we discussed, matter of fact, on the show tonight, you got to be very careful when you are converting a tax deferred investment into something like a Roth. or even pulling money out because you think, hey, you know what, taxes are never going to be lower than they are right now. Because what people always fail to realize, right, Jason, is that money that they are paying or that they're going to have to pay to Uncle Sam, or if you're in California or another taxable state, you have to recoup that. That's got to be part of the payback plan, right? So if you sell something for $100 and you're in a 20% tax bracket, you got $20 that you have to pay Uncle Sam, right? Well, guess what? You have to make that $20 back before you even really break even for making that move of converting it to a taxable investment. So be very careful. This is going to be a year as the year progresses and we start to learn more about the Trump administration's tax policies. This will be a year where I think a lot of important tax planning is going to need to be done as far as income taxes and capital gains rates and so on and so forth. So this is again where we shine a lot. We always work very closely with our clients, CPAs, and create very, very effective tax strategies, because as the old saying goes, it doesn't matter what you make, it's a matter of what you keep. And we see people all the time that, for example, load up on mutual funds in a taxable account, and then they get surprised about this time of year when they start receiving the capital gains distribution from these mutual funds. They're like, well, wait a minute here. What do you mean I owe, or I have taxable capital gains of X amount of dollars? I didn't sell anything. No, you didn't, but the portfolio manager did. So once again, that's all part of the strategies of a well-balanced portfolio, not only from a diversification standpoint, but also from a tax perspective.
Yeah. Moving into Q&A, Gail had a great question about M&A, mergers and acquisitions, with the new Trump administration. I think it's a dynamite question, and the answer is yes. I think that's going to be an area of the market that explodes over the next couple of years. That's why financial companies have been doing better. There's a couple of names out there, Moelis, et cetera, Goldman, that have really already front ran the fact that the IPO calendar probably opens up over the next several. I mean, you're already starting to see mergers in advertising right now. There's back and forth with Hershey's potentially for mergers. Kroger Albertsons, they have their own little anger, but I think you see more and more M&A over the next couple years, because of all the obvious, whereas the prior administration was more of a no first and very optically viewed as anti-competitive. But I would argue that given the cash that's on the sidelines, that all these larger companies, or even the synergies that are offered from mergers, will be looked at with a more favorable eye with this administration, that I think will be a good thing. And M&A is a wonderful low volatility strategy for you to take a look at. It's not there to knock the lights out of the ball. It's more, or knock the lights out. It's more standing in front of a steamroller picking up pennies. A well-executed merger arb fund annualizes at a 7 to 10% return. It's not a monster, but if done well, it's a nice steady grower that's a good diversifier inside of a larger portfolio.
Right. Love that advice. I see one of the questions also want to know if they want to refer someone to us, Jason, in regards to is our webinar going to be recorded that they can listen to it later? And the answer is yes. It takes roughly about a week. We have to run it through compliance. There's all kinds of things that go on behind the scenes. But on our website, we have up at the top, we have webinar library, and all of our previous webinars are there. And absolutely. So just check back every couple of days, and we'll have this webinar posted on there so you can hear the whole thing. Or like Jason said, we can send the slide deck to you at any point, between when that's ready. So definitely want to have that all available. That's a great point, and that's a great question again on the M&A side of things. And just here's a great thing that just gives me goosebumps. Strong M&A activity can just have all kinds of tentacles into the economy, right? You see not only the investment banks doing well, you see so many different areas. You see sometimes, millionaires or billionaires made overnight, newfound wealth. And then, gosh, how long has it been, my friend, since we've been able to say, oh my God, they just priced this IPO at $20, and then the first trade the next day is $50, right? Or $10 in some cases. That just creates a lot of euphoria and optimism into the market that, man, I have missed that now that you brought that up, and really looking forward to that in 2025.
Yeah, no, I agree. I think there's going to be some very interesting dynamics that we haven't been able to take advantage of Another question I'll take more broadly about crypto, not specific on any one of them, but that's an area of the market that clearly probably reads into a bunch of different avenues. The speculative aspect, right? That there's a lot of liquidity in the system, especially given the S&P is up as much as it is this year. There's a host of technologies there that I think are going to be very lucrative, blockchain wise. Some of the crypto assets that have true use cases in terms of being able to build on their platform. Those are things we'll probably get educated more and more about this year, and through, as we mentioned, through M&A, but more so just the proliferation of IPOs. You probably hear more about companies, whether they're coin-based offerings, not Coinbase the stock, but coin-based offerings will be interesting, right? There's the offering that we typically are buying stocks in via IPO. Will that morph into something that's more a crypto-based dynamic? Single stocks or companies offering shares of themselves in a completely different way. Like, those are great investment opportunities. We'll stay away from the Q&A as far as specifics on coins, merely because of our compliance, but definitely give me a call here if you want to discuss it. I have a lot of knowledge, but unfortunately our compliance doesn't allow us to share it in this venue. So please follow up if you have any questions.
Perfect. Well, we have about 4 minutes remaining. Again, the chat room was open for you to pose your questions. Again, your questions are purely private. Jason and I can see them. I want to give you a couple little off the cuff, kind of off the topic things that I want you to really think about in 2025. Number one, I've been saying this, and I'm going to continue dropping this hint a couple more times on the radio show throughout the rest of the year. This is because of everything that you've heard tonight and even more. We are so optimistic over the next couple of years because of the Trump administration, because where we are in the economy, where we are with interest rates, corporate earnings, all the positives that we've talked about. What we want to emphasize is this is an excellent time for you to get your kids and your grandkids involved in investing. I don't care how young or how old they are, get them started. Even if you have to give them a couple $100 to get them started to learn how it's done. Nowadays, of course, there's you can buy stocks, bonds, mutual funds in many cases with no commissions, no cost whatsoever. So there's no excuse about that. You can get started with a very small amount of money. But if you can just get them started and let them see what it's like to buy a share of Apple or Microsoft or Google or something, and then turn around a month later and buy another couple shares of it, it's amazing. I've seen it with my kids, how it just builds their excitement and their passion for investing. And it's almost like developing great health habits when your child is young, teaching them to exercise, play sports, etc. It's the same thing. It teaches them physical health by getting them started. If you have teenagers that earn money from a part-time job, once again, they can start contributing to an IRA account, a traditional or a Roth IRA. There's many things they can do. So that's just one item on my soapbox, Jason. Just use 2025 as a time to get your kids, grandkids involved in the stock market. Second one, this is a great time of year as we come into the end to go back and look at your beneficiaries on your life insurance, your 401ks, your IRAs. Make sure you have the people there that you want to have. Third, this is an excellent time to blow the dust off of your living trust. Take a look at that living trust. Maybe you had it created recently. Maybe it was years ago. And this is a time you need to go, hey, is this thing still valid? Or do I need to pick up the phone and make an appointment with my estate planning attorney to get it up to date? Because we see this all the time with people. They'll, buy a rental house, for example. They don't put it in the trust. They'll make a major purchase of something else. They don't put it in the trust. Remember, folks, unless that asset is titled, that has a title, is titled under your living trust, it's going to probate. You can have a great living trust. You can have 9 of your assets listed under your trust name. You can have that 10th one that has a title, a vehicle, a home, whatever it may be, and you forgot to put it into your trust or title it into the trust. Guess what? That's going to probate. Yep. Not the reason you created your trust. So this is, again, a great time as we come into this last week of the year, not only as we discussed on the show tonight as far as year-end portfolio strategies, but also just overall financial strategies. Like I said, blow the dust off the trust, take a look at it, see if it's still valid, check your beneficiaries, make sure that they're still, who you want there, especially if you've gone through a divorce in the last year or so. Make sure you got the right people. Marcy has a question. Can kids open accounts? Absolutely. Kids can do a couple different things. You can do what's called a Uniform Trust to Minor, or UTMA account. We do these. Basically, you have an adult that is on the account. The account's listed under the child's social security number. So therefore, they are responsible for the taxes, and they can make a few $100 each year without paying any taxes, and so on and so forth. But at age 18 or 25, that money becomes theirs. So we always like to have a discussion with our clients when we talk about UTMA accounts or investing for their children. What's the best way to go? We also have some clients where we tell them, look, at a UTMA is not really the best thing for them. If they're going to use it for college, use the 529 account, right? That's what it's built for. Or other times we'll say, what's this money for? Well, we hear this a lot, right, Jason? It's a kickstart on their life, right? Pay for their wedding, the down payment on their first house. Great. Open a different type of an account that we can talk to you about. So yeah, there's a lot of different types of accounts for your kids. Just remember, the child cannot own the account if they're under age 18. You have to have a guardian / a parent on there. So great question there. All right. Well, any final words from you, my friend?
We're right at an hour. So
right at an hour. We did good.
We're all talked out. Any questions that we don't cover, please send us an email. So, more than happy to have the conversation. There's no strings attached. I like good questions. They always make me smarter. So please don't hesitate to reach out. office@sanchezwealthmanagement.com, and we'll be happy to follow up with anything that you need.
Absolutely. And again, don't forget, we have hundreds upon hundreds of podcasts available. Just search us on iTunes, Spotify, Google, wherever you get your podcasts from. All of our podcasts are out there. We'll continue to build on that library. We have some exciting things that we're going to be doing with the podcast next year also. So we will continue to do our educational segments on those, as well as our blogs our webinars. And also, hey, we're two hardworking average guys. If there are topics that you really want to learn about next year, send us an email to that address that Jason mentioned, and we'll try to consider that as far as a topic for one of the webinars in 2025. I mean, we are here for you. It's not for us. We just try to bring you things that we think are important to make you a better investor and hopefully make you more money. But it's like the radio show and etc. We exist because of you, and we want to make sure that we're giving you the information you want. Same thing on the radio show topics. If there's something you want us to cover, by all means, just send us an email or give us a call, let us know. Once again, from Jason, myself, our staff, thank you for blessing us with the opportunity to be with you each and every day on the radio, for blessing us to be able to manage your retirement funds. We take it, again, very, very seriously, and we wish each and every one of you an incredible 2025 health and prosperity to all of you. God bless.